will be recorded. So good morning, and I want to thank John Kutchey, who's our guest from the NCUA today. Just a reminder that today's webinar is set up to where everyone is on mute. However, if you would like to ask a question, please do so through the Q&A or through the chat feature, and we will be able to answer your questions then. So there will be a link to the recording and the slides after today, so we should have that to you no later than Wednesday afternoon. So we're going to go ahead and start with a legislative and regulatory update, a brief one from Rory and I. And so I'm going to hand this over to Rory. Rory's going to give us an update on what's been going on now that the Senate has introduced their act to marry with the House's HEROES Act. Rory?
Hey everyone, appreciate that, John. As John said, it's just a brief update. I know you guys have all heard a lot about it. I'm just going to go over what are the differences between the two bills and what are the next steps. The high-level items for us is with unemployment insurance. Up until now, it's been $600 a week in the House package. They want to continue that $600. At least, for the time being, probably up until about January. The Senate, their package drops that down to $200 a week. And what their hope is that the UI benefits, the burden will then shift to the states to increase whatever they are giving. And as you can see below, most states are right around that 45% mark. DC, Delaware, Maryland, and Virginia sit right in there. So the Senate, their way of thinking is the states should cover most of that. And then the federal government will do $200 a week on top of it, which should make about 70% of the lost income. As we all know, many states have overwhelmed their UI systems. So there's gonna be a lot of debate around UI benefits. Another big kind of linchpin between the two is money for state and local government. The House bill has, it's $1 trillion divided between state, local governments, and a couple different tribal lands. And there's a kind of a breakdown of exactly where they want all that money to go. The Senate has put no new money in for state and local governments. There's $150 billion that was put in the first CARES Act. And they're saying, well, that is still enough and will give states a little more leeway as to how they want to use that. The stimulus checks, both the House and the Senate agree that another $1,200 stimulus check is necessary. And then with PPP loans, there's no new money in the House bill. It just explain, they say there's still money in the pot. There's still, $100 billion or so in the pot, so we don't need to add it. The major complaint that they've heard is it's too restrictive of how businesses can use that money. So they would just kind of make that a little more flexible for businesses. The Senate bill would have $190 billion added to the pot. And then for certain really hard hit small businesses, they would be allowed to apply for a second PPP loan. Can we go to the next slide, John? All right. So the next steps on this bill, obviously, these are not small differences between the House and the Senate. These are differences that will completely stall out the bill if no one is willing to compromise. The political timing makes it very difficult. The fact that a lot of states, when the CARES Act came out, a lot of states that were the hardest hit then are not the hardest hit now, and it's a completely different section of the country that is hard hit now, make this all kind of a very tenuous situation. I think if things go best case scenario, there would be some sort of compromise by the middle of August or so. Whether that happens, who knows? I've heard that there might be a couple smaller kind of stopgap bills just for certain provisions, if they can come to agreement on them, that Congress might put forward. But hopefully through August, we can get this done and continue to push forward. So that's where we're at federally. You're on mute, John.
Hey, John, I don't know if anybody else can hear you, but we're not getting any volume, I don't think.
Hey, that was the best presentation I've done so far.
There was a lot of lips moving.
Sorry about that. So, but it was good. So just to let everybody know, so last night, the bipartisan work group from the Maryland legislature came out with some recommendations on housing, and they were instructed to closely look at housing, rent relief, affordability, evictions, and if you will remember, we were able to work with the governor's office to make the forbearance portion as a recommendation, as optional. We had, the majority of our credit unions had signed on to honor the governor's request, but as things continue to progress, there's concern. So this work group was put together, and just to give you a quick summary, again, this came out last night, so we're monitoring all of this. We're setting up meetings to get a better understanding. However, the one issue would be to extend the mortgage forbearance protections under the Coronavirus Aid, Relief, and Economic Security Act, which really doesn't change what's been going on. And most of our credit unions, as far as we know, everyone that we've talked to has been following and working with consumers. I do find there are a couple of things that could be a challenge until it's better defined, which is the next two bullet points that talk about that lenders have to attest to having tried other loss mitigation efforts. And in addition, they have to enhance and also publicize what types of housing counseling programs that you have to assist mortgage holders. So those are very ambiguous statements that they've made. And again, there will be more detail, and we're working on that. We're setting up our meetings to get better feedback. So please be on the lookout. All of you have been incredibly generous with your time. When these have come up in the past, when we've talked to the governor's office and we've talked to the administration here in Maryland, DC, your engagement has been incredibly important in helping to shape what comes out of the office. So as we get more information, we will publicize it to you. We will reach out and engage for your feedback. However, please remember, these are recommendations. It's not finalized. However, there more than likely will be something coming out, given that it is a bipartisan commission. So we did want to give you a heads up on that in case you read any of the local news. There's nothing new from any of our from DC, Delaware, or Northern Virginia. So that's just really kind of the latest things that have been going on. I know we've got a special guest. John Kutchey is our regional director here in the Eastern region for the NCUA. John's been very generous with his time, both on screen and off screen, behind the scenes, with working with our credit unions and having a continuing dialogue. So with that, I want to thank John and really turn it over to John to talk about what's been going on, and the new supervisory guidance came out. So thought this was great timing to have John talk with everybody and answer any questions.
Appreciate it, John. Thank you very much. I always look forward to these opportunities to dialogue with the industry and get a feel from you as to the issues that are pertinent to you. But I first would like to give you some updates, because as John indicated, we've issued a couple things recently and have made some decisions on our exam and supervision program that have a direct impact on you. So wanted to kind of give you a little bit of an update of what those things are. So I'm going to first talk about where we are with the current exam program. Right now, we remain in 100% offsite posture. We've been there since the middle of March, so we are in the 5th month now of virtual examinations, offsite contacts. None of our staff is reporting to offices at this point, and honestly, I don't know when that's going to change. We were scheduled to begin on-site examinations July the 6th, and then everything started to spike again in the COVID world, and it put a halt to all of the plans. Our office is doing a lot of work, as I'm sure your credit unions are, with trying to track what's safe, taking care of employees, taking care of your members, and we're all adjusting as we go, and that continues to be the issue with NCUA. It's very fluid, but I'm not sure when we'll be back to an on-site posture. We are making a few on-site contacts here and there, but it's very few, very far between. And basically at this point, what we're doing is limiting any contacts to credit unions that have an issue that's really an imminent risk to the share insurance fund. The ones we've done so far are ones where we've identified fraud as an example during the offsite review procedures, and we have to go in and take care of that, obviously. Material record keeping and internal control problems are another area where we've made some contacts, because you really can't do an effective job in that area virtually. So again, few and far between. For the most part, everyone I'm talking to on the line here is in the mode of 100% off-site examinations at this point. One of the things that we did change back in June, we are back to issuing full examination reports to you, and that includes examiners' findings and documents of resolution. So we're back to a normal process, if you will, in terms of examination reports and finishing those. Joint conferences and exit meetings are being done through video conference for the most part. We're getting a lot of work done, so that's been very good for me as the regional director, that we're able to continue to move the supervision program forward. Couple things that come up as I do these calls is what should you expect from NCUA in terms of things that you've done under COVID-19 to help your members. NCUA and all of the guidances we've been issuing continually state that we will not criticize credit unions for the assistance and the programs that you've put in place, and that remains true. But we have to kind of thread a needle here. While we're not doing that, we are an insurance fund. We have to identify the risk issues. We have to appropriately rate the risk issues. And one thing I always remind the credit unions of that I speak to in these types of environments is the CAMEL system. I know many of you view it as your report card, but that's not the intent of it. CAMEL exists as a resource deployment issue for the agency. So your CAMEL rating of 1 to 5 is what we use to trigger which credit unions need more supervision from NCUA. And that's why we need to cite the risk issues that are present, even if they developed under COVID-19, and call it fairly. But we're not going to criticize you for making the decisions that you've made. Our focus is on a go-forward basis. What risk systems and processes do you need in place to make sure that you mitigate the risk to the extent possible? So it's a delicate balance. Right now, just so that you know, it's not on the slide, but the sensitivity to this is high at NCUA and at the executive level. So right now we have a standing requirement that any examination that has new documents of resolution in it, or discuss COVID-19 in terms of examiner findings or documents of resolution, I personally have to review that report and sign off on its issuance. So an examiner and a supervisory examiner do not have the authority to issue reports with that content. I actually have to physically review it and sign off and give my concurrence to it. So there is a heightened sensitivity to not being overly critical in these areas. And at least for an additional time period, that current internal review process will remain in place. One of the things I wanted to mention, and I think it actually originated here with good information I was getting back in the Maryland, DC area from John and his team, is the comment that examinations in this current COVID world are taking longer and sometimes involve more staff at NCUA than you're traditionally used to seeing. And that's largely because of the virtual environment that we're in. While it's been great and the help and the assistance from the credit unions has been wonderful, it just takes longer. The ability to exchange information in a face-to-face dialogue and answer questions and provide documentation that's right in front of you as a credit union official is a whole lot different than email exchanges. It could take 4 emails to address an issue that could be handled in a 1-minute, 2-minute face-to-face interaction. So just by the nature of the virtual posture we're in, it just takes a little bit longer. So I wanted you to know that we recognize that. We're trying to be sensitive to your time, but that's just one of the natures of the current beast that we have. I also wanted to let you know, again, not on the slide, but we have kind of shifted our focus a bit. We're still doing exams and we're still doing our normal supervision, but one of the problems or one of the challenges that we're facing is in the COVID world. John was just talking about, you know, the new wave of programs to help homeowners and mortgage and borrowers. But what all of these programs do, to just be blunt about it, it kind of masks the real economic impact of COVID-19. And I'm not criticizing the program, so don't walk away from this saying, you know, Kutchey doesn't think we should be doing this. I think you should be, and I think it's a great thing. And I think the more you can do to help your members and the consumers is outstanding. But from a risk identification and impact on the actual economy, it's masking the real depth of the problems that are out there. So we're spending a lot of time trying to come up with some risk review systems internally based off of call report data and other things to figure out where there could be triggers and areas of concentrated risk as we go forward. So unfortunately, I'd like to say that we've seen the worst of what's going to happen here to the credit unions and the economy, but I honestly don't think we've even gotten through the tip of the iceberg yet. And I know that's a sobering comment from a regulator and an insurer, but I think there's a lot more to come before we get through this. And the second wave and the second spike is just exacerbating the problem. You know, some of the things that you read. So we're putting in all these temporary programs for credit unions, but the problems are now developing in the economy that are going to be long lasting and permanent. Take retail as an example. You look at the number of retail enterprises that have gone bankrupt. That doesn't get better when COVID goes away. I was reading something yesterday. I think Yelp did a survey of restaurants, and it shocked me. It's the current information is over 60% of the restaurants that are now closed are permanently closed. It's not a temporary thing waiting for the economy to bounce back. 6 in 10 restaurants are never going to reopen their doors. So the concept that this is just a 3 to 6 month blip, I'd like to believe that, but I'm having a hard time believing that at this point. So I just wanted to give you a heads up that we're spending a lot of time trying to analyze the economy and credit union performance with the different metrics that we have. On to the supervisory priorities. So everything that I just said to you is kind of a backdrop for the supervisory priority adjustment. Normally we issue this priority letter once a year in January, to give you a heads up as to the things that NCUA is going to emphasize. But we did a recalibration here in July and issued an updated version of the letter. So I wanted to talk to you a little bit about that and give you a couple of nuggets that will help you with your examiner and knowing what they're going to come and look at when they do make a contact with you. So there are some new pieces, some modified and some things, priorities that the agency eliminated. And in a couple minutes, I'll get to that in another slide or two. But I wanted to give you a heads up of a really great link that's in this letter that I think has just been missed by most people. So I'm trying to give you guys a heads up as to a place that you can get some really good information about what we're going to look at. The letter to credit unions is in the first bullet, and if you search that on the agency's website, in the second paragraph, there is a link to the examiner's guide, and it's an online version of the guide. So when you click that link in this letter, it'll bring up the online version of our guide, and along the left side is a menu, and one of those is COVID-19. If you click that, it's going to give you a ton of information about what our examiners are going to be looking at. It summarizes a lot of risk issues. It gives you background information as to why we think they're risk issues, and gives you insight as to the types of questions we're telling our examiners to ask you. So it's a really good heads up of what's out there. So if you guys want to go to the next slide. Before I get into what's new and what's deleted, this is kind of largely unchanged from the original letter that we issued back in January of 2020. Bank Secrecy Act remains an issue. Consumer financial protection. The only change here was we added some additional emphasis on Reg E and Reg Z, and only in terms of the COVID-19 loan modification programs that are out there and the other service adjustments that credit unions have made, and they impact Reg E and Reg Z. So it's not a major issue per se. Under credit risk and the allowance for loan losses, hopefully it's obvious that for the allowance for loan and lease losses, with what's been going on in the country with the economy, depending on who you serve in your membership, you could be dramatically impacted if you serve the retail industry or the travel industry or the restaurant industry. Gas and oil is another area that's seen a lot of impact from COVID-19 and the current economic fallout. So looking to see if credit unions are making the adjustments necessary to the allowance, considering that as part of your economic factors, et cetera. It's just a point of emphasis now. In the cybersecurity area, it's been a priority of the agency for years. The new twist to this with this July update is the concept that just about all of us have gone remote, and credit unions weren't necessarily built to operate in a remote environment, particularly a 100% remote environment. And that creates additional security concerns, protection of information. So those are some of the points of emphasis that we're going to work with you on when we make our contacts. And in the midst of this, just timing, we have a new exam tool that we are releasing to our field staff to look at the cybersecurity. It's called Intrex. And I just wanted to put that out there. Nothing for us to necessarily do with it at this point, but it's more of a streamlined cybersecurity questionnaire that our examiners will go through when they see you. LIBOR transition plans remains one of the areas that needs some attention from you. Liquidity risk, again, it was in the old one, it's in this new one. The twist is member needs, liquidity demands on you. Interestingly enough, it's been, what we've seen so far has been a flight to quality. We haven't really seen a drain. Early in the first month or two, I think people started stocking up on cash and hitting up the ATMs pretty big. But then we saw a reversal of that more in the April timeframe, where money started to flow into credit unions. So the issue is actually the opposite. You've got most credit unions have more money than they can do anything with at this point. And I guess if as a regulator, I'd rather see that than the former. And then serving hemp-related businesses continues to be one of our focuses, but it's kind of secondary in the current environment. The next slide gives you what we've added and what we've eliminated. We've added the CARES Act as part of what we are emphasizing. So the different requirements and things that impact the credit unions is something we'll be looking at. And we've taken out the review of CECL, the current expected credit losses requirement at this point. And we'll talk a little bit about that. I think there's a question that's being posed in that area for a little bit later on. And the next slide before we get to Q&A.
John, real quick.
Yes, John.
John, there was a question about on the previous slide, there was you've got the discussion about LIBOR transition.
Mm-hmm.
So could you just kind of give where that does, I know that doesn't apply to everyone. So if you could maybe just give just a brief background on that for those that aren't familiar with it.
Yeah, so I'm not an expert on this one, but the LIBOR issue is more, it's being eliminated as a potential gauge for credit unions to index their variable rate loans to. And it's a very, very popular indexed rate. So as it's being eliminated, credit unions who are basing their adjustments to variable rate loans on LIBOR need to move to a new measure. And so there's legal issues, there's compliance issues and documentation issues that are part of that. And that's about all I really have as far as detail on that, but it's a measure or an index credit unions have used for, and financial institutions in general. It's not a credit union specific issue. It was considered one of the most stable indexes to bounce against for variable rate loans, and it's going away. Okay, so COVID-19 exam procedures. So the link I had in the earlier page about our online examiner's guide, I gave you a way to find it through the letter to credit unions on supervisory priorities. But this link here, and not that I expect you to type in this link to get it, but I didn't know if John has the ability to post it or somehow get that link to you. That way you can just click on it and you'll be able to get to the material with just that click if you don't go through the letter to credit unions that I gave you.
Yeah, John, we'll make sure that when we do these slides, if it doesn't come through on the PDF of the slides, that we will send a link along with
Okay.
so we'll make sure that that's out there.
Okay. So the topics that are covered, when you go there, these are the specific headings in the second bullet that are part of that. I wasn't necessarily going to sit here and go into depth into each one of these, but I wanted to let you know how they're structured. Under each of these topics, there's a little bit of a background discussion that the agency has put forward to kind of explain our perspective on each of these subjects. And then there's, if I were you as a credit union, the handy part that I would really be good or happy to see are some questions that we pose to our examiners to ask of you. And again, I'm not going to sit here and read every question to you, but I'll use credit risk management as an example. Some of the things we're asking our examiners to inquire of you is, did the credit union adjust the credit programs to address borrowers facing financial hardship because of COVID-19? And if yes, then there's a few other questions. Have you adjusted your credit risk management policies and procedures to deal with loan workouts, new strategies to fund borrowers impacted by COVID-19? Have you implemented or introduced any new programs specifically for the CARES Act? So kind of some open-ended questions. It's not going to be detailed, specific bullets that you should be doing A, B, C, and D, and that there's a wrong answer to them. But I wanted to let you know the kind of dialogue in the specific areas that we're asking our examiners to engage in with you to give them some guidance on what to get into. PPP loans is another hot topic. We're asking them to find out what your volume is. what your experience is in early repayment programs. Are you facing any consumer compliance complaints because of the program? How did you determine who gets the loan? Those types of things. So there'll be some questions that your examiner will ask in that area as well. Loan workouts is another one, but I know there's a question or two coming, I think, on TDRs and other things. So I'll save some of that discussion for that part. But we do have that in here as well. A lot of questions actually on loan workout programs, because that tends to be, I think, the area that just about every credit union has engaged in, appropriately engaged in. But it also presents a lot of potential risk to you as you go forward, depending on how you handle that and the way you went about the modifications. Credit risk limits that you may or may not have set are some of the things that we ask our examiners to explore with you. What are your plans on the back end when the modification period expires or the forbearance period expires? So those are all the types of things that the examiner will go through with you when they start to talk to you about your COVID-19 programs. The allowance for loan loss is another one that's easy sort of from a discussion point here. Are you looking at qualitative factors in your current funding? Again, depending on the type of industry that you serve, you may be more heavily impacted than another segment of the credit union community. So how are you gauging the impact on your members and the loan loss funding? I saw some interesting stats this morning, and I'm still trying to digest them, where we're tracking what the largest banks in the country are doing for a loan loss funding perspective. And I can tell you they're setting aside materially higher levels for loan losses than our credit unions are at this point. And I'm not saying they're right and credit unions are wrong. It's just an information point. So as I started earlier, I think the economic impact of this is going to be longer term, and we're not seeing the true impact at this point because of the level of the forbearance programs and stimulus checks and additional unemployment checks, and that will eventually dry up. Eventually those things go away. And my job as a regulator and more as an insurer is what's it going to look like when those things eventually dry up. And that's where I lose sleep at night contemplating those pieces. But it looks like the banking community is taking a much more conservative approach to funding their allowances at this moment than we are as credit unions. So again, just information, not a criticism. So those are some of the key highlight points. I did want to let you know that last bullet there, links to documents and resources. When you go into this COVID-19 chapter and the very last section, there's a long list of reference materials that are literally a click away. The CARES Act, the different regulatory changes that the agency has approved, the different letters and documentation pieces that the agency has issued. So it's a pretty cool place to go and get a lot of information if you want to explore the subjects further than just reading this chapter. So John, I kind of blew through that pretty quick. Want to get to the Q&A part with your folks and try to be as responsive as I can. So I'll turn it back to you.
Sure. Thanks, John. That was great. I really appreciate, again, your time and always being available, no matter what day or time of day for that matter. Real quick, one of the questions that somebody had asked, and it really is around the allowance for loan loss questions and ties into the credit union relief provided during COVID-19. At what point will COVID loan payment reductions be considered a TDR? This one credit union comments that they've typically granted 2-month deferments on consumer loans if they've been impacted by the pandemic, and then another 2 months of reduced payments if needed. So, and since some can't re-engage into their old payment structure. Maybe they have to do another loan rewrite to help them because of the pandemic. How is the TDR issue? Have you been able to create a program, or is there any type of guidance with regards to, I know the mortgage forbearance issue not to be considered TDRs, but what about regular consumer loans and other even HELOCs, that type of thing?
So that's a great question. And thankfully, this question you gave me in advance. So I had a chance to do a little research, because I would have just punted and say, talk to your CPA. So I'm going to start with that still. At the end of the day, this is about full and fair disclosure, and the TDR program is really something that's managed by FASB. And as regulators, we sort of implement their standards. So FASB really drives this conversation. But I was able to come up and sort of back into a bit of an answer, and this is John Kutchey answering this question. But I'd start again with FASB. I'd start with your CPAs for those credit unions that have that kind of a working relationship. But from what I could find, there's a couple things that I kind of zeroed in on. One is I found discussion in the different issuances from FASB and others that talk about the CARES Act, as you were just talking about, John, and they talk about forbearance programs that can go up to 180 days with the ability to extend up to another 180 days and not be considered TDRs. So without the specifics underneath of it, that tells me theoretically off the top of my head that FASB's taking a position a year seems like a reasonable period of time. Now, it's not their official words, but if they're willing for segments of the loan programs to say 180 plus 180, which is a year, that's one of the things that you should be able to talk to your CPAs and your auditors about. Is that reasonable, and use that as a starting point. The other thing that I zeroed in on, so back on April 7th, there was an interagency release that dealt with loan modifications, and it talked a lot about FASB. So all the agencies jointly issued this guidance, and I think it gets more to the crux of this question. So a couple of things that I highlighted: to be eligible as a loan modification that doesn't become a TDR, it has to be one that you did that was related to COVID-19. So the circumstances of the borrower were created through COVID-19. The loan wasn't more than 30 days past due on December 31st, 2019. And this is the important part for timing in my estimation, or my view. You have to execute the modification between March 1st, 2020 and December 31st, 2020. So those are the three conditions for a loan mod to not qualify as a TDR. So this is saying, just in this guidance alone, no earlier than, this is my interpretation, no earlier than year-end 2020 do you need to think about loan mods becoming TDRs. I mean, if you can actually originate a loan mod through the end of the year, within a period after that, and it not be considered a TDR, which is what this guidance is saying, then you certainly have longer than that time period. And the other key sentence that I read, it says financial institution accounting for eligible loans are not required to apply. It talks about the subject, the subtopic, for the term of the loan modification. So if I'm a credit union and I originate a loan mod December 1st, 2020, and it's a modification that goes out 180 days, I'm now into at least the summer of 2021 before I have to start thinking about a TDR. So I think there's a lot of maneuvering. There's nothing hard and fast that I could find to answer that, but I think all of these different pieces show that there's a lot of flexibility that FASB is applying to this situation. And hopefully I didn't muddle that too much and gave a little bit of information that shows that. So the example that the person submitted, that they've done 2 months so far and they want to do another 2 months, to me, that's a no-brainer. It certainly doesn't fall under the TDR category. Now, if the member starts to become delinquent, even with the mod that was done, I think you have a different set of challenges in front of you. And then multiple modifications. So if this example that was given was part of a 4-month expected program, and because COVID-19 is now spiking again and things haven't gotten better, need to extend it another 4 months or 6 months. I think as long as you document that, you're okay as well. But that's one where I would definitely talk to my accounting professional before I locked into that.
So one thing I know Tim Anderson has a question. Tim, you're unmuted, Tim, if you want to go ahead and jump in, if you want to unmute yourself.
I'm sorry, John. I don't have a question.
Oh, okay. No problem. So one question I had on that, John, is I know different states obviously have different, different executive orders or emergency laws. I know California, we had talked about this with some of our on one of our CEO calls, that California had a bill that it was no questions asked, 6-month forbearance. All they had to do was ask for it. No no documentation, no support for why. So if a state or the district in the region were to come out with something like that, I would anticipate that would be, if you're following the rules of whatever the state would say specifically, that would be acceptable also with the TDR issue. I think the concern is if somebody's rewriting a loan too, right, during this time, that wouldn't be considered a TDR. If somebody's situation changed where maybe their significant other lost their job, in those examples, if you have to rewrite, that wouldn't be considered a TDR either.
Yeah, John, I think in this document that I mentioned, the one issued on April 7th, it talks about documentation, and there's been a lot of scale back of those requirements and expectations. Normally you had to really provide an in-depth rationale and reason to support each of the transactions, but given what's been done at the state level, really, I mean, you could repeat what you just said about California in a lot of states, and maybe 4 months instead of 6 months, or 3 instead of 6, or longer. So you I think the accounting profession needs to gauge accordingly to what those expectations were and the standards. But I think FASB has noted that minimum level of documentation and information in this circumstances, really at this point, they're saying it says a loan mod must be related to COVID-19. So I think that's pretty easy to document in the current point in time. And the rest of it is just credit union records. Was it delinquent at the time? Or was it 30 days or more delinquent as of year-end 19? Those are really the two standards, according to FASB, that give you that pass on a TDR. And of course the timeline, but that's something that's just kind of automatically documented as the transaction date. So I think they're already acknowledging that minimum documentation and support is perfectly acceptable.
Great. I don't know if you can see the question there that just came in. Will there be any forthcoming guidance on CRE participations given the exposure?
I don't have the answer to that. I haven't talked to our policy office. It's something I can follow up on and see if I can get an answer to.
Yeah, I would think that's the one challenge, right, is some of the commercial real estate, obviously, as you were talking about earlier. A lot of things are.
The second one of these I've done, John, that CREs have actually come up. Commercial transactions are, I think, going to become more stressed as time goes by as well. So I think it's just the nature of the beast. There's a lot of places out there now that are, not going back to an office environment in the future. So I think the commercial real estate market has long-term issues that we haven't even begun to understand yet. I think there's a lot of people that are still living in the belief in the world that once COVID magically disappears, everything goes back to normal. But I don't know that that's actually the case. I think the world has realized that teleworking is very viable. Working in a virtual environment is very viable. And I think renting and leasing commercial properties is going to become super challenging over the next couple of years. Now, 5 years from now, we may swing back to that, but I think we're in this current posture for a while. Again, that's John Kutchey's opinion. That's not an official agency spot. That's just me using my business sense. So don't go publishing that NCUA believes the commercial real estate market's going to collapse. I'm just sharing what my worries are.
That's good. Well, your disclaimer is on record, so that's a good thing. So don't have to worry. So in the chat, John, I'll pop this back up. There's a question with regards to the appeal rights. If a credit union can't resolve an issue with their examiner and wants to appeal, has any of that changed, or is it still the same process if there's an appeal on the exam?
It's still the same at this point, John. We go through the regional chain of command process first, and then the board has authorized and put in place additional flexibilities for the credit union to review or to appeal to our Office of Examination and Insurance. We have a more robust supervisory appeal process. But I can tell you, so I've been the regional director now for 6 months, and I view the credit union appeals request for reconsideration of things a little bit differently, I think, than some others. I spent 8 years in our executive director's office at the agency, so I was away from the field program long enough to gain a different appreciation for the credit union challenges and the appeal processes. So one of the things I've done that kind of flies below the radar, traditionally when I first came in and an appeal would come in from a credit union, the review for reconsideration just automatically went to the first line field supervisor. But I don't necessarily always agree with that, because the first line field supervisor may have been as included in the decision making with the examiner as the examiner themselves. And to me, that's not a fair way to judge and assess an appeal. So I've been much more frequently taking the appeals that come in and assigning them to a different office under my supervision to actually do the independent assessment, someone who's not attached to that case. So my hope is to get a more objective view of what the credit union's concerns were and balancing that against what the exam staff saw. I don't automatically just give it back to the field program to confirm that they were right. It just logically doesn't make sense to me. So I've tried to create a little bit of a wall and bring other people involved into the process who were not part of the case to begin with.
Thanks, John. One question that also was asked early before we started was, you touched on exam schedules like on 4 and 5s and the increased supervision, but for those that are a CAML 1, 2, or 3, is there any difference in the schedule of the exams depending upon that, depending on their rating, or if you're 1, 2, or 3, your exam schedule is going to continue on that same cadence?
Yeah, right now we haven't officially changed our posture. So if there's certain conditions that get you into one of 2 exam cycles. So we have the extended exam cycle, which means your exam, you should have at least 14 months and up to 20 months break between exam contacts. And we measure that break from completion of one to the start of another one. So there should be a period of 14 to 20 months for credit unions who meet several conditions. If you're a code 1 or 2 composite rating and a code 1 or 2 in management, if you're under $1 billion, if you have greater than 7% net worth and no DORs that deal with significant record keeping problems. If you meet all of those conditions, then you would fit into this 14 to 20 month exam period. And basically, as simple as I can say it, everyone else falls into an 8 to 14 month window from completion to start. And that's kind of the program that we have. It's still the official one at this moment. But I can tell you, as COVID has gone on, we can't necessarily make all of the contacts that we normally would. We're doing the best we can, and I've been extremely pleased as the regional director with the amount of work that we've gotten done. It's far exceeded what I thought we would be able to do virtually. But we are starting to run into, I'm just sharing this bluntly with you guys, we're starting to run into some challenges with credit unions that would be on the smaller end of the scale, who we're still given the option to be examined to, and they're not necessarily wanting us to, and don't necessarily have a great reason for us not doing it. I mean, I'm not going to hurt my own feelings here by saying this. We're the federal government. We're there to examine you. If I had a choice not to be examined, I'd pretty much take advantage of it too. On the other end, we have a job to do, review and protect the insurance fund for the greater good of 5,000 credit unions. So there's some internal discussion going on right now as to what's the right time to actually require credit unions to begin to participate, because we've been in a voluntary mode now for going on 5 months, and we're sort of at the point where I think we need to do something that's going to require more than less.
I don't think we have any more questions, John. I know we're getting close to our timing here. Again, this has been great. As always, appreciate all the information. I'd like to thank you, and also if you could pass on to Martha. I know we've had a lot of conversations with you and with CURE on working with credit unions, whether it's their charters, enhancing their charters, or helping some credit unions with mergers. And I know you guys have been very responsive, even given some of the crazy times that we're in. So I really appreciate that. So
always my pleasure, John. Love to help the industry. The mission of credit unions is my passion in life. I've given 30 years to federal service and 5 years before that in the credit union industry. So I've spent my entire adult life in the credit union industry. So whatever we can do to keep it safe and healthy, serving members, the mission of credit unions is unlike any other in the financial sector. So anything I can do along the way to help you and credit unions, I'm more than willing to do.
Thanks, John. I really appreciate that.
Sure.
So everybody, just want to, the last thing just got, just a little bit of a reminder. This year we are moving forward with our tech summit. So we've got an incredible lineup. If you haven't seen it, just jump out to our website and you can register and take a look. The virtual tech summit will take place August 25th and 26th. And if you are registering through 3 or more folks, there is a 25% discount. So that's another advantage to getting a good group there. So I think you'll be impressed with the group that's going to be speaking. As always, here's just a list of our resources for folks. Again, this will be out there. If you have any questions, whether it's about advocacy, about anything from a regulatory standpoint, legislative standpoint, please don't hesitate to contact us. And a reminder that League Info site and also Policy Pro are part of your membership. And League Info site has been updated. There's been a lot of updates going on. Rory's been doing a lot of heavy lifting to help kind of, especially from UCC and other things throughout the country. So jump on there if you have any questions, or if you need anything else, just feel free to give us a call. And be on the lookout for our next town hall in a few weeks. And we'll be letting you know topics, and we appreciate everybody's feedback. If you have any ideas, thoughts, or requests for future topics, please let us know. And with that, we're done. And we stayed right on time. Thanks, everybody. John, thank you again. Rory, thank you. And thank you all for taking the time this morning to be with us. Have a great day.